Are your dividend stocks just sitting there? What if I told you that 5 of Singapore's biggest blue-chip companies are quietly getting ready to give their shareholders a serious pay raise in 2025? We're not talking about small change here. We're talking about significant dividend hikes that could supercharge your passive income. Stick around, because in the next 9 minutes, I'm breaking down our deep dive institutional research to reveal which 5 giants are poised for a dividend acceleration and which one we're 95% confident about. You won't want to miss this. Before we dive in, a quick and important reminder. This video is for informational and educational purposes only. It is not financial advice, and you should not consider it as a recommendation to buy or sell any security. Please consult with a qualified financial advisor before making any investment decisions. All right, let's set the stage for 2025. With interest rates expected to come down, that 4% you're getting from your savings account might not be around for much longer. That's why a growing stream of dividends is so crucial. It's not just about the payout you get today, it's about finding companies that can consistently increase that payout tomorrow, beating inflation and truly growing your wealth. We're looking for companies with rock-solid finances, growing profits, and clear signals from management that they're ready to share more of that success with you, the shareholder. So let's get into the top 5. First up, with a very high 95% confidence level, is a name we all know, DBS Group Holdings, D05. DBS has been a dividend machine. Just look at its track record, from $1.30 per share in 2020 to a projected $3 in 2025. That's an 18% average annual growth rate. Their finances are like a fortress. They have a capital buffer, known as CET1, of 16.9%, which is way above the 9% minimum required by regulators. Think of it as having nearly double the required safety cushion. Management has already signaled a 10% increase for their 2026 ordinary dividend. With wealth management fees booming and a payout ratio of just 56%, they have plenty of room to keep the dividend train rolling. The risk? A sharp economic downturn could slow them down, but their strong balance sheet is built to withstand shocks. Next on our list, with a high 90% confidence, is the Singapore Exchange, or SGX, S68. SGX is a quiet compounder. They've laid out an explicit roadmap for dividend growth, committing to quarterly increases of 0.25 cents through 2028. This isn't a guess, it's a public promise. For fiscal year 2025, they delivered a solid 9% dividend increase to 37.5 cents per share. What's fueling this? Their business is growing steadily, with revenues projected to grow 6 to 8% annually. They are seeing huge growth in derivatives trading, especially with their China A50 futures. With a payout ratio of 62%, they are in a comfortable spot to keep rewarding shareholders. The main risk for SGX is a major market downturn, which would reduce trading volumes, but their diversified business provides a strong buffer. Coming in at number 3 is our comeback kid, SATS, SATS, with a high 85% confidence level. SATS, which handles airport ground services and catering, had to halt dividends during the pandemic, but they are back with a vengeance. After reinstating their dividend in 2023, they grew it by an incredible 233% in fiscal year 2025 to 5 cents per share. Now here's the exciting part. Their payout ratio is only 30.5%. Peers in their industry typically pay out 60 or more. This means SATS has the potential to double or even triple its dividend without breaking a sweat as profits normalize. With the aviation industry roaring back to life, massive new kitchen expansions, and strong cash flow of $1.1 billion, SATS is set for a major dividend inflection. The risk is that a global recession could hit travel demand, but for now, the tailwinds are strong. Our 4th pick, with a moderate high 80% confidence, is ST Engineering, ST63. ST Engineering is a defensive giant, and right now they're in a special dividend window. For 2025, they're expected to pay a total of 15 cents per share, which includes a 5-cent special dividend from selling off some assets. While the special dividend is a one-off, their ordinary dividend is also likely to rise. Their order book is at a record $32.6 billion, giving them clear earnings visibility for the next 2 to 3 years. Think of it as having a backlog of confirmed sales that guarantees revenue. As they reduce debt and expand margins in their booming commercial aerospace division, there's a strong case for the ordinary dividend to grow steadily after this special payout. The key risk? A cut in global defense spending, but their business is well diversified. Finally, our fifth stock, also with a moderate high 80% confidence level, is a REIT recovery play, Capital Land Integrated Commercial Trust, or CICT, C38U. As a REIT, CICT is all about distributions. After a dip, their distributions per unit have been recovering strongly, up 36% in 2024. For 2025, we're looking at another 3 to 5% growth. What's driving this? The Singapore retail scene is on fire. With tourism recovering and limited new mall supply, CICT is seeing rents go up. Occupancy across their portfolio is a very healthy 96.4%. Recent upgrades to their malls, like Lot 1 and Tampines Mall, will also boost income. While their office portfolio faces some headwinds, the strength in retail is more than making up for it. The risk for any REIT is rising interest rates, but with rates expected to fall, this becomes a tailwind for CICT. So there you have it, 5 blue-chip titans poised for a dividend boost in 2025. We have DBS, the fortress bank with a clear path to higher payouts. SGX, the exchange with an explicit multi-year dividend growth promise. SATS, the aviation player with massive upside potential as its payout ratio expands. ST Engineering, the defensive stalwart offering a special dividend with more to come. And CICT, the REIT riding the wave of a strong recovery. These companies offer a compelling combination of stable earnings, strong balance sheets, and clear catalysts for growth, giving investors a chance to lock in attractive yields of 5 to 5.5% with the potential for those payouts to grow 5 to 10% annually. Thanks for joining me for this deep dive. If you found this analysis helpful, do me a favor and hit that like button and subscribe for more data-driven insights. I'd love to hear your thoughts in the comments below. Which of these dividend stocks is on your watch list? Remember, this video is for informational purposes only and is not financial advice. Always do your own research before making any investment decisions. See you in the next video.